There are moments in markets when the surface tells one story, but the foundation tells another. Thursday was one of those moments. Most people saw red screens and assumed collapse. Gold fell more than 3%. Silver plunged over 10% in a single trading session. Panic spread quickly, social feeds lit up, traders blamed profit-taking, technical breakdowns, algorithmic selling. But if you step back from the noise and look beneath the headline numbers, what actually happened may be far more significant than the price drop itself. Today is Friday, January 13th, and the real development is not what fell. It's what moved quietly underneath the system, while most were distracted by volatility. As I'm recording this, gold spot sits at 4,156, down 3.97%. Silver trades at 76.74 after losing 10.65% in the last 24 hours. A 10% single-day move in silver is not normal. It's the type of move that liquidates leverage, triggers cascading stop losses, and forces weaker hands out of positions. When silver falls that hard that fast, it's rarely random. It's mechanical, it's positioning, it's stress revealing itself through price. And yet, while the paper market was collapsing, the physical market was behaving in a completely different way. The Shanghai silver benchmark continues fixing at roughly $10 above Western spot pricing. Not a few cents, not a minor discrepancy. 10 full dollars per ounce. That is not a rounding error. That is a structural divergence between two pricing systems. Eastern buyers are paying materially more for physical silver than Western derivatives markets are suggesting it's worth. And here's where this becomes critical. That spread has not closed. It has persisted for weeks. Under normal conditions, such a large price differential would not survive. Arbitrage exists specifically to eliminate inefficiencies. Traders would buy silver in the West at the lower price, transport it to Shanghai, sell at the higher price, and pocket the difference. Supply flows to higher pricing. That's fundamental market behavior. But that mechanism has not equalized the spread, which suggests that something is interfering with normal flow. Some of it can be attributed to logistics and capital controls, but the deeper issue may be availability. There may not be enough immediately deliverable physical silver in Western vault systems to close that $10 gap at scale. If the metal were abundant and freely accessible, the arbitrage would already have erased the discrepancy. The fact that it hasn't tells you the pricing tension is real. This is what David Morgan was referring to when he said the physical market is beginning to assert control over paper pricing. For decades, London and New York derivatives exchanges have dictated global precious metal pricing through leveraged contracts. But when sustained physical premiums emerge in the world's largest physical trading hubs, authority begins to shift. That doesn't happen overnight. It happens gradually, then suddenly. Now let's examine the COMEX data, because the inventory movements are where this story becomes difficult to ignore. Official depository statistics dated February 11th show a single-day negative adjustment of 256,182 ounces in the registered silver category. That's more than 3 million ounces removed in one session. Registered stocks now stand at 98,138,050 ounces. That drop below the 100 million ounce level is historically significant. It's the first time in modern tracking that registered silver has fallen beneath that psychological and mechanical threshold. But it doesn't stop there. An additional 4.7 million ounces were withdrawn from the eligible category. That represents a net withdrawal of approximately 4.7 million ounces from the COMEX system in just 24 hours. Pause and consider that. Nearly 5 million ounces of physical silver left vaults on the same day that the paper price collapsed by over 10%. If falling prices were signaling falling demand, physical withdrawals would slow. Instead, physical metal moved out aggressively. That divergence between paper price action and physical inventory flow is not a small detail, it's the detail. For those focused purely on charts and technical structure, it's understandable to interpret Thursday as breakdown. Moving averages rolled over, momentum cracked, support zones were pierced. But technical tools measure positioning and psychology within the derivative market. They do not measure underlying scarcity. When you trade futures contracts, you're trading a claim, not necessarily the metal itself. Open interest in silver remains in the hundreds of thousands of contracts. Meanwhile, registered inventory now sits below 100 million ounces. The ratio between paper claims and deliverable metal has been elevated for years, but as that physical buffer shrinks, the system relies increasingly on confidence rather than surplus supply. Confidence works until it doesn't. Now widen the lens further and look at the macro backdrop, because this sell-off did not occur in isolation. Over the past 3 weeks, 18 U.S. companies with liabilities exceeding $50 million filed for bankruptcy. That pace approaches levels last seen during the 2009 financial crisis and marks the fastest acceleration since the pandemic period. Corporate America is not collapsing overnight, but stress is building. The era of zero interest rates that allowed weak balance sheets to survive has ended. Refinancing at higher costs exposes fragility. At the same time, the New York Federal Reserve reports household debt has reached a record $18.8 trillion. Mortgages, auto loans, credit card balances, student loans, all sitting at historic highs. Leverage is embedded throughout the consumer system. Serious credit card delinquencies climbed to 12.7% in the fourth quarter of 2025, the highest since 2011. Younger households are carrying disproportionate strain, facing rising costs without equivalent wage growth. These numbers are not random statistics. They are late-cycle indicators. Historically, rising bankruptcies and increasing delinquencies precede policy responses, rate cuts, liquidity facilities, monetary easing. And when those responses arrive, currency purchasing power becomes the pressure valve. Ray Dalio has written extensively about this pattern in long-term debt cycle analysis. Debt crises rarely end in immediate collapse. They resolve through currency debasement. The nominal value of debt remains, but its real burden shrinks as purchasing power erodes. In those environments, hard assets preserve value more effectively than paper claims denominated in weakening currency units. Now consider Bitcoin within this same framework. The digital asset trades near $65,000 and has remained under pressure. While often described as digital gold, it has not yet proven itself through a prolonged deleveraging cycle absent immediate liquidity rescue. In 2020, central banks flooded markets quickly. We have not yet observed how digital assets behave during extended tightening without rapid intervention. That does not negate Bitcoin's potential role. It simply means the current data set shows something different. Physical demand for gold and silver remains visible through inventory movements and sustained premiums, even as digital assets consolidate. Some analysts suggest that once gold stabilizes near the $5,000 level, capital rotation into digital assets could accelerate. That's possible. Markets rotate. Capital seeks perceived value. But no asset class is guaranteed performance. What matters is the divergence. Silver drops 10% in a day. 5 million ounces leave vaults. Shanghai pays $10 more than Western spot pricing. Bankruptcies accelerate. Household debt reaches $18.8 trillion. Delinquencies rise to 12.7%. Individually, these are headlines. Together, they form a pattern. And patterns, not panic, are what define structural change. If you study market history long enough, you begin to recognize that the most explosive phases never feel explosive at the beginning. They feel confusing. They feel unstable. They feel contradictory. That is exactly where we appear to be now. David Morgan recently suggested that the silver market may be entering its final phase of this bull cycle. That statement carries weight, but what matters more is the historical behavior he referenced. In prior cycles, roughly 90% of the total upside move occurred during the final 10% of the time span. The majority of gains were compressed into a narrow window after long periods of consolidation, frustration, and sharp corrections that convinced most participants the opportunity had already passed. That framework changes how you interpret volatility. When silver collapses 10% in a day, the immediate instinct is to assume weakness. But historically, violent shakeouts often occur before acceleration phases. Extended sideways periods exhaust patience. Corrections remove leverage. Sentiment resets. Then, when positioning is light and skepticism is high, the move that defines the cycle begins. Physical demand trends reinforce that possibility. India reportedly added 40 million ounces of silver into exchange-traded funds within a 2-month period. That is not trivial flow. India has long been one of the largest consumers of precious metals globally, and when demand of that magnitude enters documented vehicles, it tightens available supply. 40 million ounces absorbed into ETFs reduces liquidity in an already tightening physical environment. Simultaneously, the Shanghai Futures Exchange is implementing stricter hedging quotas effective March 1st. Participants will be required to demonstrate legitimate physical business ties to justify their positions. This represents a meaningful structural shift. It signals a move away from purely speculative leverage toward positions connected to real commercial activity. Exchanges do not tighten requirements without reason. When paper volume expands beyond physical foundation, credibility risk increases. Enforcing physical linkage reduces speculative distortion and gradually alters the nature of price discovery. Now let's examine the bearish case in full clarity, because sustainable conviction demands acknowledging opposing arguments. A 10% single-day decline in silver and nearly 4% in gold does inflict technical damage. Charts that were trending upward now show breakdown. Traders who bought recent dips may find themselves underwater. Support zones that previously held may convert into resistance. Momentum indicators weaken. In the short term, that kind of structural damage often requires time to repair. Additionally, while registered COMEX silver has fallen below 100 million ounces, the exchange has tools to manage delivery stress. Cash settlement can be offered in lieu of physical delivery. Contracts can be rolled into future months. Position limits can be adjusted. These mechanisms have historically prevented headline-grabbing default scenarios. The system has operated for decades without formal collapse, and there is no guarantee this cycle results in something different. Further, although 18 U.S. companies filed for bankruptcy in 3 weeks and credit card delinquencies have climbed to 12.7%, these numbers, while elevated, do not yet represent systemic implosion. Most households continue servicing debt. The broader economy may muddle through a stagflationary environment without triggering panic-driven safe haven demand. It is possible that stress stabilizes rather than escalates. Those are legitimate considerations. But each of them assumes continuity. They assume that the existing framework continues to function as it has. They assume central bank intervention remains effective without side effects. They assume that the divergence between physical and paper pricing resolves in favor of derivative markets rather than physical scarcity. That is the assumption embedded within the bearish case. Now examine the cost of the management tools themselves. If cash settlement is offered at a premium to spot price, that signals shortage. If contracts must be rolled aggressively because delivery demand exceeds immediate supply, that signals shortage. If position limits are adjusted to suppress volatility, that signals imbalance. Every tool deployed acknowledges pressure beneath the surface. They may extend timelines, but they do not eliminate structural tightening. Then reconnect the macro environment. Household debt stands at $18.8 trillion. Corporate bankruptcies are accelerating. Serious delinquencies have reached the highest level since 2011 at 12.7%. These are late cycle signals. Historically, when leverage becomes strained, policy response follows. Rate cuts, liquidity facilities, expanded balance sheets. Those actions stabilize markets temporarily, but weaken currency purchasing power over time. The playbook from 2020 illustrates this clearly. Precious metals initially fell during liquidity stress, but once monetary expansion accelerated, gold and silver moved to new highs within months. Intervention created the conditions for appreciation. Liquidity does not vanish without consequence. It shifts purchasing power dynamics. If similar intervention occurs in response to rising bankruptcies and consumer strain, the implications for hard assets become straightforward. Currency debasement supports scarce tangible stores of value. That relationship is repeated across multiple economic cycles. The sustained $10 Shanghai premium remains perhaps the clearest real-time indicator of structural change. When the largest physical silver exchange prices metal materially higher than Western derivatives markets, and that spread persists for weeks without closing, it signals that arbitrage cannot operate freely at scale. Price discovery may be migrating toward markets where physical settlement carries greater influence. How long can that divergence remain before Western pricing adjusts upward? That question defines the next phase. Now revisit Bitcoin within this broader macro environment. Trading near $65,000, it has not yet demonstrated resilience through a prolonged deleveraging cycle absent immediate central bank rescue. In 2020, liquidity injection was swift and aggressive. The coming test may differ if tightening persists longer before intervention. That does not dismiss digital assets. It highlights that their macro behavior remains in development. Some analysts argue that if gold consolidates firmly near or above $5,000, capital could rotate more aggressively into digital assets. Markets do rotate. Liquidity seeks relative opportunity. But assumption must always be secondary to observation. Physical inventory withdrawals, sustained premiums, and rising debt stress are observable. Narratives about rotation remain conditional. The environment ahead rewards discipline. It rewards those who separate daily volatility from structural movement. Silver's 10% decline dominates headlines. 5 million ounces leaving vaults in the same 24 hours tells a deeper story. A drop below 100 million ounces registered inventory is not symbolic. It reduces the cushion within the system. Volatility creates emotional reaction. Structural tightening creates long-term consequence. Monitor the Shanghai premium closely. If it widens beyond $10, pressure intensifies. Monitor registered COMEX silver. Continued decline below 98 million ounces increases sensitivity to delivery demand. Monitor bankruptcy filings. If 18 in 3 weeks becomes 25 or 30, credit stress accelerates. Monitor credit card delinquencies. A move toward 15% shifts strain toward crisis. Monitor Federal Reserve communication for softening tone or liquidity language. Monitor the March 1 implementation of Shanghai hedging quotas as enforcement may alter speculative volume. These markers, not daily price swings, define trajectory. We are not observing isolated events. We are observing convergence. Tightening physical supply, elevated leverage, growing credit stress, and potential policy pivot risk. And convergence is what precedes transition. Now we reach the point where interpretation matters more than reaction, because what we are watching is not just volatility in a commodity, it is tension building inside a pricing system that has relied on leverage, confidence, and abundant supply for decades. And when supply begins to thin, while leverage remains elevated, the character of the market changes, whether participants acknowledge it or not. Registered COMEX silver now stands at 98,138,050 ounces after falling below the 100 million ounce threshold. That number is not just symbolic, it represents deliverable metal backing a vast number of paper contracts. When registered inventory shrinks, flexibility shrinks with it. The thinner the physical buffer becomes, the more the system depends on the assumption that most participants will not demand delivery simultaneously. That assumption has held for years. It continues to hold, for now. But inventory does not lie. 5 million ounces leaving vaults in a single day while prices collapse suggests that physical demand is not fading. It suggests accumulation during weakness. And when physical flows contradict paper price, it forces a simple question. Which signal reflects underlying reality? The persistent $10 Shanghai premium reinforces this tension. Eastern buyers continue paying materially more than Western derivatives markets imply. Arbitrage has not closed the gap despite clear financial incentive. That is not typical behavior in an efficient global market. If physical supply were abundant and frictionless, that spread would compress quickly. The fact that it does not indicate structural constraint. Over time, price discovery migrates toward markets where real settlement carries weight. If physical exchanges consistently reflect stronger demand than paper venues, pricing power gradually shifts. That shift does not require dramatic headlines. It unfolds quietly until one day the adjustment appears sudden. Meanwhile, macro pressure builds in the background. 18 U.S. companies with liabilities exceeding $50 million filed for bankruptcy in 3 weeks. Household debt has reached $18.8 trillion. Serious credit card delinquencies stand at 12.7%, the highest level since 2011. Younger households carry disproportionate strain. These are not panic numbers yet, but they are late cycle signals. Historically, when leverage strains and credit stress rises, policy response follows. Rate cuts, liquidity facilities, balance sheet expansion. Intervention may calm markets in the short term, but it alters purchasing power dynamics. Debt does not disappear. It is managed through currency adjustment. In those environments, scarce tangible assets tend to preserve value relative to depreciating currency units. This is not speculation. It is historical pattern. Now, acknowledge again the counter-arguments. The exchange has tools to prevent delivery default. Cash settlement can be offered. Contracts can be rolled. Position limits can be adjusted. The financial system has survived previous stress episodes. It may survive this one as well. Precious metals may consolidate further before any sustained move resumes. Silver's 10% decline may require time to rebuild technical structure. All of that is possible. Markets are not guarantees. They are probabilities. But every tool used to manage imbalance carries signaling effect. Cash settlement at a premium implies shortage. Aggressive contract rolling implies insufficient near-term supply. Adjusted limits imply pressure. Temporary stability does not erase structural tightening. It merely postpones confrontation with it. At the same time, digital assets like Bitcoin remain near $65,000, consolidating rather than accelerating. The narrative of digital gold remains untested through prolonged deleveraging without rapid liquidity rescue. Both digital and physical assets may benefit under currency debasement scenarios, but the current data clearly shows sustained physical demand for metals. Some analysts suggest that once gold stabilizes above $5,000, capital rotation into digital assets could intensify. That may occur. Markets rotate. Liquidity shifts between perceived stores of value, but structural signals must guide interpretation. Inventory flows, debt levels, delinquency rates, bankruptcy acceleration. These are measurable realities. Now consider the psychological aspect of this phase. Sharp corrections like Thursday's drop create doubt. They are designed to. When silver falls 10% in one session, conviction weakens. That is the purpose of volatility in leveraged markets. It forces reevaluation, it tests positioning. But volatility in paper contracts is not the same as erosion of underlying scarcity. If physical premiums persist, and vault inventories continue declining during price weakness, then price alone does not tell the entire story. Which price carries more information, the leveraged derivative price or the physical premium paid for immediate delivery? Long-term participants prioritize structural supply and macro direction over short-term fluctuations. Short-term traders prioritize momentum and liquidity. Both perspectives exist simultaneously, but they serve different objectives. Watch the key markers closely. If Shanghai's $10 premium widens rather than compresses, physical demand remains dominant. If registered COMEX silver continues declining below 98 million ounces, delivery sensitivity increases. If bankruptcy filings rise from 18 in 3 weeks toward 25 or 30, credit strain accelerates. If credit card delinquencies climb beyond 12.7% toward 15%, consumer stress deepens. If Federal Reserve language softens toward accommodation, liquidity dynamics shift. If Shanghai's March 1st hedging requirements reduce speculative volume, structural paper leverage contracts. These developments define trajectory more than daily candles. Could precious metals correct further? Yes. Could the economy avoid immediate crisis and drift sideways? Possibly. Could paper markets suppress volatility through leverage dynamics for longer than expected? That too is possible. But the convergence of tightening physical supply, sustained international premiums, record household debt, rising delinquencies, and accelerating bankruptcies suggests equilibrium is becoming fragile. We are not observing collapse. We are observing transition. Transitions reward preparation more than prediction. They reward those who monitor data rather than react emotionally to headlines. They reward disciplined position sizing, diversified exposure, and independent verification. This is not financial advice. It is analysis based on publicly available information, inventory reports, debt statistics, bankruptcy filings, pricing spreads. Every number discussed can be verified. Decisions remain personal responsibility. Protecting capital comes first. Opportunity comes second. Surviving volatility positions you for structural moves when they unfold. Because structural shifts rarely announce themselves with certainty. They begin quietly, build pressure beneath the surface, and only later become obvious in hindsight. The divergence between paper and physical silver pricing, the decline below 100 million ounces registered inventory, the macro stress building in corporate and household balance sheets. These may be early signals of that shift, and the market rarely gives advance notice before adjustment arrives.